Welcome to the seventh lecture of this Economy 2022 Prelims series. In the previous video, we have started the chapter 4 of this year's economic survey. We have talked about a few concepts related to quantitative tools of monetary policy for liquidity management. Moving on from there. In the previous videos, we have dealt these two topics, and today we'll be talking about the developments in G-SAP market. In the previous video, we have talked about the importance of CRR and SLR as a monetary policy tool. We have talked about repo, reverse repo, VRRR, LTRO, TLTRO. All this were discussed in the lecture 6. If you haven't watched it, please go back to that and watch this video. We will be discussing in this video other quantitative tools like open market operations and GSAP. But before we talk about these quantitative tools, we will have to understand certain basics. This single picture can give us an idea about the problems that RBI faces, the stakeholders it should deal with. So, RBI, being the controller or a regulator of money supply in our economy, should deal with, on one hand, the government, financial intermediaries like banks, and common men, that is, Indian citizens. So, if we categorize citizens into two categories, you have bank depositors, that is, common men, and then you have investors who would be investing in our economy and help in our economic growth. The common point that RBI should look at is everybody in this picture will be trying to maximize their interest. Everybody needs money. The government would need more money for welfare activities. Banks and other financial intermediaries would want more interest and more revenue. Investors would want more returns, and common men would want more interest for their deposit rates in banks. So everybody wants money, and it is impossible at the same time for RBI to keep all of these stakeholders happy. This is the funda you should understand. Now, how does RBI manage all this? Through monetary policy tools. We have already seen a few of them. Now we'll be looking at a new concept to understand the rest of them. In the fifth video, when we were talking about the concept of money multiplier, we have seen how banking institutions or financial intermediaries are very crucial in money creation. Now, when we are talking about financial intermediaries, we also have financial markets. So, if you take a look at financial markets, broadly speaking, there are two different kinds or two different modes of raising money or creating money. They are bonds and equity. In this picture, you're looking at a bond. What exactly is a bond? It is a kind of an agreement by the borrower that he would pay back the amount with an interest. So, what is the incentive for the person who is giving money? That person will earn interest. Now, take a look at this bond. This is generally a presentation of a coupon bond. Why is it called a coupon bond? There are coupons associated with this. You can take a look at this coupons. So let's say, for example, if each of this coupon says that if the person who holds this coupon goes to the central bank or the person who has borrowed that money, and let's say if 8% is the interest that is promised to the person who has given this money, upon showing this coupon, 8% money should be paid as interest by the person who borrowed this money. So this is the concept of bond. Now, when you're talking about equity, what does it mean? Equity means a share in a company. So basically, when we are buying an equity, we are buying a part of ownership. Here in the bonds, there is no ownership, and in equity, there is ownership. So profit or loss, you are going to have both here. So there is an element of risk when you're talking about equity, but there is absolutely no risk if you are an investor in a bond, because the person, irrespective of the loss or profit, should pay back that interest. Now, in a market, bonds will be issued both by the government as well as corporate. Now, if you are a common investor, you have an option to invest in both of these. Depending on the circumstance, let's say in a time like COVID, who is more likely to default? corporates are more likely to default than a government. So government securities or government bonds will become attractive. And you have to remember that if economy is actually booming, nobody would want to invest in bonds because equity will give higher returns. Let's say you almost see a lot of posts that if you have invested around 1 lakh rupees in Eicher Motors, which is the parent company of Royal Enfield, somewhere around 2004, it would have gone like 100 times or 10 times or whatever may be the number. This is not possible in a bond, it is possible in a equity. Therefore, when the economy is booming, people would invest in equity. You have to understand these concepts to know what we are going to talk about. I hope this is clear now. Moving on. In the previous example, we have seen a bond with certain coupons attached to it, and these coupons are the instruments through which you can redeem your interest or get your interest payment. Now, if that bond had 5 coupons, naturally the tenure will be 5 years because one coupon is valid for 1 year. So how much money will the investor get? Let's say if he's investing 100 rupees for a bond and it is likely to give in 5 years 40 rupees interest. So total 140 rupees will be the money that the investor will get back. Now, if it had just 3 coupons, then the tenure is 3 years and 24 rupees is the interest. So when we talk about the word yield, it means how much are we getting. So naturally, in the first case, we are getting more yield than in the second case. So what is the conclusion that we can draw? Longer the tenure, more profit or yield an investor gets. Now, let us imagine the case where the person who bought this bond at 100 rupees after staying invested for 2 years, he got 8 plus 8, 16 rupees as profit. Now he decided that he wants to pull out that money because he has some need. So he is willing to sell this 100 rupees bond for 95 rupees only. Now this person who bought this bond at 95 rupees will have 3 years. So 24 rupees is the interest that he will be getting plus 100 rupees which is promised by the government is also given. So in this case, he is earning some profit also, that is 5 rupees because he bought it at 95 rupees and not 100 rupees. So total is 29 rupees profit is what he is going to get. So in this case, we can say that this buyer who bought the bond has higher yield than the original person who bought this bond. This is the concept that you have to understand. Moving on. Now let us consider a scenario. For example, in a market, if there are only 100 government bonds or government securities, and within that 100, 30 of them are held by just 1% of the investors, and the rest 70% are held by the rest 99% of the investors. Now, this small group decides to sell this government securities. So, previously the cost was 100. Now, because they want to move out, they started selling it for 95 rupees itself. So what will happen? The yield will increase for the people who are buying next. Now when you have this kind of a scenario, what will happen? The rest 70% of the investors will start panicking. So a rise in bond yields in the market will bring the price of the bond down because these 70% of the people, while looking at this 95 or the 1% of the investors, they might sell this in a panic. This is not an ideal scenario or real time scenario. This is just to understand the concept. So a rise in bond yields in the market will bring the price of the bond down. Now imagine, for whatsoever reason, these 1% of the investors decide to buy all the government securities in the market. Whatever was the price here, it was 100 rupees and it will increase to 105 rupees. So the yield will actually come down, but the bond price will increase. So the value of the bond will increase, which is good because it is generating capital gains for the investor. So in the market, both the government as well as corporates need money. Let's say in the case of corporates, they are willing to give more money than that of the government. So they are willing to give 10% interest. But the problem is, at 8% interest itself, the government securities are yielding 15% returns. But corporates are giving a yield of just 15% returns because of the volume of transactions in the market. So obviously, with less risk, if you are getting 15% yield, the investors would prefer to invest it in a government security rather than that of the corporate. So this is the problem. So when bond yields go up, it is a signal that corporates will have to pay a higher interest rate, because if interest rate in the short term is much more attractive, people would want to hold that bond for a longer time. And let's say if a company is giving 15% interest regularly, you would not think about selling that bond, and therefore that will be a attractive investment. But it is not possible that it will be sustainable for the corporates to give that kind of money in a longer term. So this is the dilemma that companies will have. Now here is where RBI will intervene. For any economy to grow and sustain the welfare activities, economic growth or GDP growth is must. So one of the component of GDP growth is this investment. Now, in order to facilitate this investment, RBI will use its monetary policy, how we have already seen in this previous videos. Now, managing bond yields along with interest rates in an economy is also the job of RBI. So naturally, when you have a company X which is showing a lot of promise for the future of our economy, that company should get capital from the market. People should not just be risk averse, because if you take a look at any economy, any economic growth is possible only when risk is taken in good investments or good companies which have a lot of potential. To give an example, if IT sector has to grow after the 1991 LPG reforms, it needed capital and investments. Where did that come from? By the creative destruction of inefficient companies. So this is how money keeps on growing. So it is not the job of RBI to just help the government and secure the government securities. I mean, if there are no new companies, how will the government sustain that kind of welfare activities? New companies will create more employment and pay more taxes. So always priority will be given to spur economic growth, but at the same time, RBI should manage the risk also. Now, by reducing the yield, it will make investors who are just worried about their own interest forcibly think about good investment avenues. So investors will have to work harder to earn money and invest in good companies rather than just trusting blindly the government. It is not sustainable for any economy. People should work to invest also. In this scenario, what are the options available for corporate bonds to make it more attractive? Let's say, for example, if Reliance's Ambani wants to raise money for his new ventures, he has the following options. One, if the inflation in an economy is 6%, obviously it should be much more higher than that. Otherwise, people would be making loss in such kind of an investment. So it should be more than inflation. That is why we have inflation indexed bonds. For example, there can be bonds which say, for example, if CPI is 6%, these kind of bonds offer CPI plus 2%, that is 8% interest. That is one way to attract for risk averse people. Or have good credit rating history. It's like a review for the previous loans that this company took. If it is good, people will obviously invest in that company. Third one is give more interest than banks. Banks, for example, if they're giving 5% FD rate, and companies should ensure that they give 8% to 10% to attract more investment. And lastly, they should ensure that they give better yield than government securities if they are traded in the secondary markets. So Here is where RBI's help becomes very important to contain unsustainable yields on government securities. This is a picture from economic survey, and if you take a look at this trend, yields are actually increasing in the past few months. Now, in this scenario, if government wants to raise more money, for example, we have the Gati Shakti National Infrastructure Pipeline project where we are raising a lot of money. Now, imagine in this scenario, if the government securities yield is some X%, obviously, when the government is borrowing more money, we will have to pay more than this, because what is the incentive for an investor to invest in these new bonds when the existing bonds are having such a good yield? So this is the thought process that RBI wants to address. Now, what could be the reasons for fall in the prices of these government securities? There can be a lot of reasons. Now, let's say in times of COVID, we have seen even the best companies during the first lockdown hit a market low, all time low. Now, a share usually in normal times, let's say a very good share like Geo, this was trading around 800 rupees when its normal is around 2000 rupees. Now, people who were invested in government securities thought that it is the time to take a risk because they know that a company like Geo will eventually bounce back. So they disinvested from this government securities and wanted to invest in stocks which are at their all-time low and yet have a huge future potential. So equity is giving better return. This is one of the reason. Apart from this, apart from the crisis situation, even in situations where there is economic boom, where there is a lot of scope for growth, let's say the period between 2003 to 2007 in Indian economy, this was the phase of economic boom. Even in those times, instead of just relying upon the 4 to 5 to 6% interest rate that the government securities would be giving, people took risk, because in equity, that is in share market, they were getting almost 40 to 50% returns. So this is a much better option. So even for that reason, people might pull out money from um, the government securities and invest in share markets. Or there can be a possibility that foreigners might exit the system and dump the government bonds because of other opportunities, or it can be a reason of RBI's policy or US Federal Reserve rates. Let's say in the COVID crisis, for example, if the government in US is giving loans at 1%, people use that loans to invest in the Indian market, which is giving them 5% returns. So they just have to pay 1% return and 4% is their profit. But after COVID, when situations got better, this 1% was again raised to, let's say, 5%. Then they would not uh, resort to this kind of situations, right? So foreigners dumping government bonds and US Federal Reserves are kind of interlinked. So what is the bottom line here? Market is always dynamic, and it responds to not just interest rates but also government security yields. So RBI will try to manage both of this through the monetary policy committee's repo rate and through certain open market operations which try to contain this yields. Let us have a look at this 2021 question. Indian government bond yields are influenced by which of the following? We have already discussed this. Answer is 1, 2, 3. Now let us discuss about Operation Twist. Going back, in an economy, there is a supply side and a demand side, and a mismatch between the supply and demand will create inflation, as we have already discussed multiple times. Now, it is the job of RBI to use government securities and other assets that it has with it to ensure that inflation is contained. One such operation is OMO, or open market operations, wherein RBI sells or buys government securities. This is to contain the supply of money in an economy. This is a screenshot taken from RBI's website, and you can see here we're talking about government securities that will mature in 2061, and they have interest rates roughly in the range of 6 to 7% or 7.5%. Now, an investor who invests in this kind of bonds would be getting 15% yield regularly, because in the market, the government security which has a face value of 100 rupees, that is the value at which government sold that bond in the market, that will be traded in the secondary market, let's say for example in the range of 93 to 98 rupees. Even though the interest is just 6.95% and a new private player comes into the picture and offers an interest rate of 8%, he is risk averse and does not want to care about this private bond. If he's so risk taking, he would rather invest in equity if he believes that company would work. But what if the company fails and he defaults on the interest? So he would not take the risk. He is more interested only in government securities. Now, in this situation, economic growth will become difficult for this company, and here is where RBI will intervene. Now, what will it do to reduce yield? How will a bond yield reduce? If RBI enters into the picture and increase this money, uh, that is the cost from 93 to 98 to let's say 102 rupees, obviously the yield comes down. Now, for this investor, it would be much more attractive if he is now investing in a private company. So, this is the first step of Operation Twist. RBI buys long term government securities from the market and thereby reduce the bond yield. Now, let's imagine the person who previously held this government security at 93 rupees suddenly got 102 rupees from RBI on the account of this operation. So, obviously, money supply will increase. Now, RBI wanted to solve the problem of bond yield. That is solved. But what if inflation increases? We are talking about the long term prospects. Now we are forgetting the short term inflation impact. Now, in order to contain this, RBI will also do one more activity. So, usually short term bonds, that is 1 to 3 years or 1 to 5 years, whatever bonds are there with RBI, RBI will sell that. Now, when you sell bonds, what will happen? Money supply will decrease. So, two steps of Operation Twist are therefore completed. RBI has reduced the bond yield of long-term government securities and thereby the cost of borrowing for government, and at the same time in the short term it manages the inflation also. That is why it is considered a special type of open market operation. Don't go beyond this point, it might confuse you. So just understand that the purpose of Operation Twist is reducing the bond yield. So this Operation Twist is not something that RBI invented in 1960s. US government actually did this. So we are using the same logic here. We buy the long term securities and sell the short term securities to manage inflation as well as bond yield. Now let us try to understand the concept of yield inversion. What does a bond yield indicate? Yield indicates the profit that an investor will earn. Now, if the bond yield is high for a long term security or a long term bond, what does it indicate? It indicates some sort of a hope that this economy would work. But if it is flat, it means that economy is growing very marginally and we can't expect some wonders from this economy. But if it is inverted, this is a problem because there is no hope that investors are showing on the future prospects of an economy. The future growth is expected to fall sharply. Now, here is where we have to understand this concept of yield inversion, which is very crucial even in the global financial crisis 2008. So, what happens in this yield inversion concept? So, if we take the example of the 2-year tenure bond of US and the 10-year tenure bond, 2-year is a short term bond and 10-year is a long term bond. So yield inversion is a phenomenon where the yield on 2 years is higher than that of a 10-year-old. That is, the yield on 10-year bond is lower than that of 2 years. So you're only showing interest on the short term prospects, and the long term prospects, the investors are not really hopeful. So this is a classic case where recession might be possible, as seen in the case of 2008. So if this happens in Indian economy, it means that investors don't show hope in the future of our economy. So we RBI will try to do everything in its control to avoid this kind of a scenario. In simple words, yield inversion is a possible scenario when there is recession. This is all you have to remember. Now, one possible question from economic survey: after COVID, the gap between uh, the short-term bond yield and the long-term bond yield has actually widened when compared to the pre-COVID times. So this is all you have to remember. Even this is very unlikely, but just in case if UPSC decides to surprise us, just remember this point. So we have seen the most of quantitative tools already. Now we are left with GSAP. What is the next step that RBI took? In the COVID times, capital was locked because of the lockdown scenario, and people did not have working capital to run their businesses. Now, instead of actually reducing the repo rates where interests were already low, it's like people don't want to take new loans and pay interest for that. They actually wanted to unlock the capital that they invested in government securities. Now, if they want to sell their government securities, RBI should buy them, right? But normally, RBI will intervene in the open market operations only when it has to deal with the inflation scenario. So people were actually demanding a window where RBI will unconditionally buy the government securities that they are holding and unlock this capital. In order to address this, on a particular timetable based unconditional buying by RBI, capital was unlocked. That program is called GSAP, or the Government Securities Acquisition Program of RBI. What kind of securities were bought by RBI? Treasury bills, that is less than 1 year, and dated securities, that is between 5 years and 40 years. The reason for this is, even uh, state governments wanted more capital. They wanted to sell their own government securities. Now, this GSAP is followed by a number 1.0, 2.0, because this happened in two windows and a fixed amount. It is not important to remember the amount actually. This fixed amount for a timetable based window was used by RBI to procure the G6 that are available in the market. Now, here is where you have to understand another term called quantitative easing, because a lot of newspaper articles talked about this term called quantitative easing, calling that GSAP program of RBI is similar to quantitative easing. But there are certain fundamental differences. You have to understand what GSAP means and what quantitative easing means. During the 2008 financial crisis, a lot of companies went bankrupt. So during that time, US government has actually bought the shares of those private companies as well as government securities from the market. Just because RBI is procuring government securities, a lot of people thought that GSAP program is just like this quantitative easing. But there is a fundamental difference. What is the purpose of quantitative easing? It is to infuse liquidity into the market or increase economic activity, economic activity in the market. That is why US government bought private shares also. But here, what RBI is trying to do is just yield management. This is clearly visible in RBI statements, RBI governor statements. The aim of GSAP is not to infuse liquidity. This can be a prelims question. Please remember this point. In fact, RBI is trying to remove this excess liquidity through variable repo auctions, which we have discussed in the previous video. If you compare that with quantitative easing, it's quite different. GSAP mainly tries to create demand for the government paper, thus keeping finance cost of public and private borrowers in check. That means RBI is doing yield management here, not liquidity infusement through GSAP. Please remember this point. In this context, you have to understand the complicated role that RBI plays. On one hand, it controls money supply and foreign exchange supply, and it also has a role as a banker. So it is the banker to the government and therefore handles its government securities, sale, and management. At the same time, public debt management is also something it handles. And finally, it is considered a banker's bank because it is the lender of last resort where banks fail. Also, it is a regulator of all the banks and payment systems in our country, and also the regulator of various all India financial institutions and non-banking financial companies. It has role as the protector of consumer interest. It takes up activities that promote financial inclusion, and also acts as the nodal agency for various monetary related international organizations, reports, publications, etc. Like, say, for example, the Basel Committee or the International Monetary Fund, RBI is the nodal agency. Such a complicated role, and the most discussed and debated role of RBI is pertaining to its conflicting roles of managing the debt versus inflation, because RBI has a difficult time managing both this. That's why there is a call for the creation of Public Debt Management Agency, a separate entity that manages public debt. When we are talking about the chapter of public finance and other uh, issues, we'll be discussing more elaborately there. Now, let us have a look at the question asked in last year's prelims exam. This is a controversial question amongst aspirants because take a look at this option 3, lending to governments to finance budgetary deficits. Now, a lot of people thought that even this comes under the aspect of lender of last resort. Now, this is not what we mean by lender of last resort. This is actually the role of RBI as the banker to the government. If you take a look at what lender of last resort means, basically it means that it is helping banks to overcome their temporary crisis when every other avenue is closed. Therefore, two only is the answer. The first option is obviously not the duty of RBI, as we have already discussed. To conclude, what is the purpose of GSAP? It is orderly evolution of yield curve according to RBI documents. So if you like this essay, please like, share, and subscribe and wait for the subsequent lecture. And if you want the PDF of this lecture series, it will be uploaded on the Telegram channel, the link for which will be provided in the description box below. That's it for now. Thank you.